Hello everybody, a very warm welcome to ST Capital's official YouTube channel and a very happy Independence Day to all our YouTube viewers. Today we are going to continue our journey which we started in the last session. Today is actually the second session of our 4-session series where we are trying to provide some very good pointers for the beginners in the equity market. These pointers will help them start studying on their own and start investing in the equity market. At the end of the session, as usual, there will be a free stock recommendation. So, coming back to today's topic. In our previous session, we discussed briefly about fundamental analysis and technical analysis. We also provided some pointers on both sides. It will be great if you have missed to go back and watch that video. Today's session, we are going to discuss two more major aspects of equity investing. 1. Price point. 2. Meaningful diversification. So let's start with the price point. Today's world, we are all very acquainted, very used to the concepts of deal, offer, promotions, buy one, get one free. We see that everywhere. Let me confirm one thing right away. In the market of equity investment, in the world of equity investment, there is no such concept of promotion, deal, or offer. So, something is trading at a historical low price or at a price point which is lowest in last 2 years or 3 years doesn't mean it's a good deal. You have to be very careful. You have to thoroughly analyze the situation before you decide to take a position in that particular stock. There are several reasons why you will see some stocks trading at a 2-year low, 3-year low, or something like that. In our world, there is a saying, do not try to catch a falling knife. And that is a very important concept because if you try to catch a falling knife, there is a high chance, probably more than 95% chance that you will end up injuring yourself. Thereby, we always say that if there is a consistent downtrend in the price, please be careful. There is a very low chance that situation will turn around. Mind it, I used a term consistent. So if there is overall economic downturn or a temporary situation because of which the company is not able to perform well, then it's a different story. But if you see a consistent downtrend, please be aware. Let me try to provide some examples here which may help understand you the concepts. One very significant example will be some sectors are not really favored by the government or policymakers. For example, fossil fuel. The world is moving towards renewables and for valid reasons. We all know that. So what happens with the companies who are in the business of fossil fuel? Coal. However good they may be performing on their own, however good the management be, however good the policies are, however good the quality of the product they produce may be, crux of the story is they are not favored by the policymakers, they are not favored by the government. So if you now go back and take a look at the Coal India stock, you will understand exactly what I'm trying to tell you. Another example is some companies fail to embrace emerging technologies and they fall behind. A classic example, Kodak. Many of us really grew up with the Kodak moment, that famous ad, you remember, right? So Kodak failed to adapt new technology. It failed to change itself. When Canon and Nikon and other companies like that were coming out with new digital cameras, Kodak never tried. They were still living in that film world. And today, you see the consequences. So it is imperative to stay competitive. A company has to embrace changes. It has to respond to the disruptive changes. And if a company fails to do that, then eventually it will go out of business. However good the management be, well, there is a question. If they fail to embrace a change, can you really say that management was good? But anyways, I think you got the idea. The next thing, if you look at the company financials, they may be telling you a very good story there, why price is falling consistently. If you look at the revenue growth, or how much revenue it has generated over past 2-3 years, and if you see a significant downtrend, that means there is something wrong with it. Another thing to watch out for is debt level. In our previous session, we have discussed debt level is something, a key point to be noted. For equity investors, it is very important that you make a note of company's debt level. If the debt level is rising, that's a bad news. If you have missed our previous session, please go back and watch. You will be able to relate to what I am saying now. So thereby, before I move to our next topic, I would like to summarize this. There is no deal, no offer, no promotions going on in the equity market. So guys and girls, please be careful. Something is cheap doesn't mean it is a good deal. Now, the next topic of today's session, meaningful diversification. For many beginners, it may seem that diversification is nothing but buying multiple company stocks, maybe multiple companies from different sectors. So, in this video, I would like to discuss at least two aspects of diversification. There are many strategies we use for diversification, but today's session I will discuss about two things which are really key. In the world of investment, we say diversification is the only thing which comes for free, and hence it is very important that a beginner appreciate the concept of diversification. Now, when I'm talking about diversification, let me start with the concept of different type of stocks. When I say different type of stocks, what I'm talking about is growth stock, value stock, income stock. I'll try to explain what they are in next 1 minute or so. Growth stock is stock of a company which is growing at a much faster rate compared to its peers in the same sector. A classic example, Amazon. Value stock is a stock of a company which is doing pretty good. It's generating sufficient revenue. There is a revenue growth. The fundamentals are looking brilliant, but for some reason, market fails to recognize that, and hence it is trading at a price level which is lower than where it should be. All experts around the world all the time is looking for value stocks. The third type of stock, income stocks. Income stocks are typically stocks of the companies who are pretty stable, who generate sufficient free cash flow and distribute that free cash flow as dividend among its equity holders. Unlike growth companies, growth stocks, income stock companies are companies who are not on that exponential growth path. They are very stable, they are doing good, but growth companies, growth stocks, there you will see free cash flow is reinvested because they are expanding, they are revising their growth forecast every now and then. Unlike them, income stock is where they will distribute this as dividends, and they will, that's the essence of them. Examples, oil and gas. Then you have utility companies. Insurance companies and pension funds are big investors in this kind of stocks. In fact, retirees across the globe rely on this kind of stocks. This quarter, BP has revised down its dividend by 50%, and that has been a shocker. And hence, everywhere, retirees depending on BP stock dividend is really having a hard time. But as we all know, COVID-19 situation and BP had to do it. Anyways, also a very good point to be noted here. Amazon has never ever provided any dividend to any of its equity holders. So you see the difference. So depending on your financial situation, your financial goals, you have to diversify your portfolio in a way you have right proportion of these different kind of stocks. Thereby, it's very important that you recognize these three types of stocks and do your analysis and build your positions according to your situation. The next thing I'm going to cover from the diversification perspective is often there are sectors which are unrelated to each other on the surface level, but there are some underlying things which is pretty common to both. For example, a beginner may invest heavily in pharmaceutical sectors and IT services sectors, maybe 2 or 3 stocks in each sectors, and think that this is a good diversification. Especially sitting in India, it's not the case because India exports IT services, India exports medicines heavily. Hence, both these sectors have a huge exposures to Forex. Any adverse movement in the Forex situation will actually affect both these sectors really badly. Hence, it is very important that you actually recognize any underlying link. At a glance, they seem to be completely different thing, a pharma company and IT services company. But one quarter, there is a really adverse movement in the Forex market and both of them will really suffer badly. Another thing to be cognizant about is even when you are buying stocks of 2 or 3 different companies in the same sector, you may not be able to diversify to the extent you want to. I'll go back to IT services and pick up examples. There are companies in the IT sector who primarily export to US, who primarily export to EU, and who exports globally. Now, if you buy stocks of 2 companies who are major exporters to US and they hardly export to any other country, then your portfolio is not really diversified because any downturn in US economy because of terrorist attack, because of president's policy, because of anything, both of these companies will suffer equally. And hence, you have to do your homework before you buy multiple stocks of different companies in the same sector. There are many concepts around how to do meaningful diversification. You will need to study on your own, but here in this video, we tried to provide you some food for thought, which will help you understand how you start your journey to achieve a meaningful diversification for your portfolio. With that, I will now move on to our free stock recommendation. Today's free stock recommendation is JSW Steel. As usual, the target price, the target sell price, stop loss price, all of those are shared with SD Capital's clients. But for our YouTube viewers, I believe if this works for your portfolio, this is the right time to build your position in JSW Steel. And as you have seen in past, the stocks we recommend have done fairly well over past months. All said and done, today's session comes to an end now. Happy Independence Day to all our YouTube viewers once again. Let's start our journey towards financial freedom today. This may be the best day to start such a journey. Thanks everybody. Thanks for watching. Take care. Stay safe. Stay corona free. See you again in 2 weeks' time. Bye.